Okay, so the plot thickens, right? So make or buy decisions are pretty straightforward, at least from a cost benefit perspective, financial perspective. Special order decisions are very straightforward. But the question of keeping or dropping segments becomes a lot more complicated, and we will get into this. Okay. So first of all, we have some vocabulary. The question of what is a segment. A segment is a subunit of a company of sufficient importance to warrant the production of performance reports. So it's really, a segment is sort of defined by your ability to track it separately from other things. And, you know, just like with make or buy decisions, we're looking at relevant cost information, relevant information for the business segments that we're looking at. And then in order to be able to look at the relevant information, we need to have reports generated so that we have the information. And these segment income statements or segment reports are given on a variable cost basis. So we are really interested in variable cost, contribution margin, etc. And both the contribution margin and the segment margin on a segmented income statement are useful, and in particular they're useful for identifying which information is relevant for making effective keep or drop the product lines or the segments. So it's important in, first of all, using variable costing. What that means is that these are reports that break out the variable cost from the fixed costs or the fixed expenses, because fixed expenses can be broken down further. There are fixed expenses that are directly associated with the segments, perhaps the supervisor's salary for that particular product line. And then there are common fixed expenses which don't go away even if you drop the segment. So perhaps the CEO's salary. Right? So it's important to distinguish between direct fixed expenses and common fixed expenses. Okay, so you'll hear some vocabulary. Direct fixed expenses are traceable to a particular segment. They are also sometimes referred to as avoidable because they go away if the segment is eliminated. Right, so if the segments, for an example here, this is a good example, if the segments were sales regions and you decide to eliminate a particular sales region, then the direct fixed expense would be the rent for the sales office. Right, that makes sense. And then common fixed expenses don't go away even if you get rid of one of the segments. For example, depreciation at corporate headquarters, right? And so what happens sometimes is that you'll see products looking like they're unprofitable because common fixed expenses have been allocated to the unit cost of the product or to the overhead of the product, but they just don't go away. And so what happens is if you eliminate segments on the basis of misallocated common fixed expenses, next thing you know, you're out of business. Okay, so here's our example about how to prepare a segmented income statement. And I'm actually going to make you suffer through watching me do the data entry in Excel, because I want to show you how to get from this information that they give you to the actual income statement in the end, right? So remember from our budgeting practice, we had assumptions going in. So we start with sales, our variable cost of goods sold, and direct fixed overhead. And then if we go over to the next slide, we'll see the rest of the assumptions. So we have, let's see, sales commission. It was 5% of sales. And direct fixed selling and administrative was $10,000 for the MP3s. And you know what? Let's take this out of here because it's 5% on both, right? Okay, so it was $10,000 for the MP3s and $15,000 for the smartphone. Okay, and there we go. Common fixed overhead for the whole factory. Let's get that an empty line there. Common fixed overhead was $100,000. That's right. And common S&A was $20,000. Okay, so there's all our assumptions, and now we need to take those assumptions and turn them into an income statement with proper formatting. Right? So, how about we think for a minute about what an income statement is supposed to look like? Right, so I'm going to jump ahead to the next slide. And what you want to do, right, you want something that looks like this. So just like when you're doing any of your Sengeis, right, you start with the column headers on the left-hand side. So I'm going to pause this for a second and do all this data entry of the names of the accounts, and then I'll turn it back on when I show you how to actually fill the numbers. Okay, so I did all the data entry and formatting, and I made my little segmented income statement look kind of like the one on the PowerPoint. So now I'll show you how to build this from our assumptions. Remember from our budgeting unit that you never enter numbers twice, and you keep your assumptions separate from your calculations and your reports. So we're just going to go pick up all these things and calculate some of them and figure it all out, right? So here's all of our column headers. So this is just your typical income statement account order, and you just need to kind of know that and think about it logically, right? So we're going to pick up our sales figure for the MP3 players from above. We are going to pick up our variable cost of goods sold from above. And our variable selling expense, we are going to calculate as this 5% figure times the sales, like that. And that will give us our, if we subtract our expenses from the sales, that'll give us our contribution margin. So we're going to subtract minus 200 minus that 20. My computer sometimes acts a little weird when I'm recording. All right, so that's our 180, and you'll notice that I'm doing this in one column all at once, because what am I going to do when I'm done with all of these? I'm just going to copy the whole thing over to the smartphone column. Our direct fixed overhead then is that $30,000. I lost myself for a minute there. Our direct selling and administrative, a little weird that they gave that to us outside of the original assumptions, but that's how the world is, right? Things aren't necessarily laid out for you nice and neatly. We subtract those from the 180 to give us our segment margin of 140, and that's as far as we go with the segments. So let's just go ahead and copy all this stuff over to the smartphone column, and that'll give us all those numbers, which, yep, those are right. And then for our total, we have to sum them all up, right? So it's that number plus that one. And copy that all the way down. Lost my formatting, that's always annoying, but we'll do it again. Paste, so there's our 230,500, and then here's where we add in our common fixed overhead, again picking it up from above, never entering it directly. Common selling administrative, and that gives us our operating income of the margin, the total segment margins, minus the fixed overhead and minus the common selling administrative, and that gives us 110,500. So that's how you actually create a segmented income statement from those kinds of inputs. Okay, so this next example, I'm just going to walk through. I'm not going to do it in Excel because all you have to do with this particular example is just look at the information that is presented and the way that it's being presented. Let me see if I can make this bigger. There we go. Okay. So we have just received the income statement shown in panel A of slide 53. So let's go take a look at that. Okay, so here's panel A of slide 53 over here. And it's showing, because they allocate the common cost, it's showing gamma here as losing $13,740. Okay, so that's what we are presented with first. Just look at this section here, section A. Okay, so what you need to look at here, right, we've got, all of our direct fixed expenses assigned to this gamma and alpha and beta, etc. And then they allocate, as we were taught to do when we're figuring out unit costs, right? They allocate that $100,000 across the three products, and it doesn't necessarily have anything to do with how much profitability there is in the products to start with. I mean, I would want to know, gamma, it's got a contribution margin of 52,000 on sales of 364, whereas alpha has a contribution margin of 100,000 on sales of 300. So, gamma is not the most profitable of these three products by a long shot. But the thing is, right, these common costs don't go away. If you get rid of gamma, what happens to your common costs? Well, now that $100,000 in common cost would have to be spread through only alpha and beta. And so, eventually you can basically drop products that look like they're being unprofitable because of allocation of common costs and wind up with no profitability at all because there's nothing to carry that overhead. Right, so gamma is not as profitable as the other two segments, clearly, but it is profitable if you stop considering the allocated common costs. And I should mention that I know for a fact that in strategic management, you will be faced with these kinds of decisions. You'll need to remember this stuff when you get to Management 419. This is a really important capstone kind of concept. Okay, so here is an example of how to actually structure a keep or drop product line problem. And again, I'm not going to put this over in Excel because the analysis, once you understand what it is that you're doing, is pretty straightforward. Okay, so we have all these different products. We have three different products: blocks, bricks, and roofing tile. And the roofing tile has a contribution margin of $10,000, but there are direct fixed expenses associated with this roofing tile, including advertising, supervisor salary, and depreciation. And it looks like the roofing tile is losing $45,000. However, depreciation doesn't go away. Depreciation, as you recall from last night, that's a sunk cost from last night, the video 1. Which I made last night. And that's a sunk cost. It doesn't go away. Right, so that's not going to be a relevant cost. So let's run through the rest of these slides and see how this one works out. So as I just said, there was a contribution margin of $10,000. The relevant fixed costs include the $10,000 in advertising and $35,000 in supervisor salary. So those actually go away. They're not going to be spending $10,000 a year on advertising roofing tile, and they're not going to be spending that $35,000 on supervision. And so what we need to do is list the alternatives, list the relevant benefits and costs for each alternative, and which alternative is more cost effective and by how much. And so obviously the two alternatives are to keep the roofing tile or to drop it. The relevant benefits would be, well, we'll see them on the next slide. I'm not going to walk through this. Okay, so the relevant benefits would be sales of $150,000, but then here's our expenses, right? Our variable expenses of $140,000, and then our advertising is also a negative negative $10,000. Supervision, negative $35,000. So even without considering depreciation, which doesn't go away, was still losing $35,000 by having that product line, right? So in this case, because these are traceable, these are avoidable costs, the cost of advertising and the cost of supervision for that product line, then we should go ahead and drop it because we would be losing less money. Now there's a twist, right? There's a twist. What happens if, the product that you drop, because it looks like it's a dog, actually causes your other sales to decrease as well? A lot of times people come along and they, come into your store to buy what's called a loss leader, and then they also buy profitable products. And so if you dropped your loss leader, your customers would stop coming and buying the other products as well, and so your overall profit would go down. So let's look at how you analyze those kinds of situations. So again, I'm going to just walk through this one. Hopefully it'll make sense for you. Our situation is the same as our last, right? Remember, we were losing money on the roofing tiles, and we decided that it would make sense, that it would actually improve our bottom line by $35,000 to actually drop those roofing tiles. But what happens if we drop those roofing tiles and it reduces one product by 10%, our blocks? It actually reduces the sales of blocks by 10% and the sales of bricks by 8%. So what happens then? What should we do in that case? Now, work with me here, okay? Previously, we had a contribution margin from the blocks of $250,000. And if we reduce sales by 10%, then we're going to also reduce the variable cost by 10%. So that means that our contribution margin decreases by 10%. So we're going to go down with our contribution margin by 10% down to $225,000. Right, so we've already lost 25 of the $35,000 we thought we were going to save. Right, so now let's take a look at this. Right, so the bricks, okay, we had an original contribution margin for bricks of $320, and if we reduce that by 8%, now our total contribution margin for the bricks goes down to 294.4. So if we keep the dog of the tile line, right? We had $580,000 in total contribution margin, minus the advertising, minus the supervision, so that gives us a total contribution margin if we keep the tiles. If we drop the tiles, we're going to have a total contribution margin of that 225 plus 294. We're going to avoid some of our advertising costs. Remember, $10,000 of our advertising costs, so that's $20,000. We're going to avoid some of our supervision costs. So our total supervision costs then in this case are going to be $77. And so that means that we're going to have a total profit or operating income of 422 if we drop the tile. Whereas if we keep the tile, we're going to have a total profit of 438. So that means that we are $15,000 to the good if we keep that product relative to dropping it, if dropping it means that our sales drop of the other products. Okay? All right, we're going to end this one here, and then we're going to go on to the next little twist in this kind of analysis.